Hi everyone, this is the 2026 Mentorship Program Lecture 9, and the topic for this lecture is how to trade the London section. Now, on the previous lecture, I told you guys that if you were to trade the lower time frame, that you need to see the higher time frame alignment, you need to know how to approach the lower time frame, and the best way for you to approach the lower time frame is with a higher time frame perspective. That if you have a higher time frame perspective, if you know where price is trading to from a broader time frame, using the 1 hour and the 5 minutes for an entry model, looking for those specific times when you will be looking for those intraday setup. Now, in this lecture, I will be showing you guys how to approach the London section. What are the points of interest, or what are the key factors for you to pay attention to when approaching a specific section, which in this lecture is the London section. On the weekly time frame on Euro USD. Now, if you have watched this week live top down analysis, you know that my overall bias on Euro USD is that I'm anticipating higher prices for price to respect the weekly order block. I'm looking for price to respect the weekly order block to trade higher to run the buy side liquidity. So when looking at the lower time frame, you need to look at the higher time frame first. So have a clear perspective and to be sure the price is actually trading to that price. So I told you guys that as long as price stays above the mid range of the order block, I will be anticipating higher prices for price to run the buy side liquidity. On the daily time frame, on Monday, price traded above the daily fair value gap. Price did not trade lower to trade below the mid-range of the weekly order block. Monday traded higher, closed above the daily fair value gap. Seeing that price is trading above the daily fair value gap, I was anticipating price to use the daily fair value gap as an inversion fair value gap to trade higher. When you have an overall bias from the weekly time frame, the days for you to go into lower time frame to look for your setups are the days where the daily time frame is ready to expand to the overall idea. Now, saying that Monday traded through a daily fair value gap and the next draw on liquidity, if price were to use the daily fair value gap as an inversion fair value gap to trade higher, should be the buy side liquidity, which means Tuesday we will be anticipating an up close candle for price to trade higher. And our first draw on liquidity should be previous day's high, and the overall target should be the buy side liquidity. So, for those that went through the 2025 mentorship program, you know that whatever day you are anticipating an up close or a down close, you should reference back to the idea of the power of three from the opening price. And I told you guys there are two major patterns you can see form an opening price is either from the opening price, price will trade lower below the opening price when you are anticipating higher prices. Price will trade below the opening price to run a discount liquidity. After the run on a discount liquidity, price trades above the opening price. This is the first phase, trading below the opening price to a discount liquidity below the opening price. The second phase is the continuation above the opening price, where price is retracing to a 1 hour point of interest to use as a support area to trade higher. So it's either you're taking advantage of the first phase or you're taking advantage of the second phase. Now, when it comes to section, in some cases, this might fall into the London section, or in some cases, this might fall into the London section. But in an ideal scenario, they should be around the London section where price is going to form the low of the day, and a retracement to a 1 hour point of interest for price to respect to trade higher should be the New York section. But you can still make a scenario where price trades below the opening price during the Asian section, but for the London section, price is already above the opening price. You're just looking for price to retrace to a 1 hour point of interest during the London section to look for the higher prices. Now I'm telling you the specific times for you to look for your trades. Make sure you reference back to the power of three. A retracement to a point of interest after the opening price of the section, so a 1 hour point of interest, you anticipate higher prices to the next draw on liquidity. So in this example, during the Asian section, price retraced below the opening price, traded higher above the opening price. The London section was aligned with the continuation phase above the opening price. Playing it forward, you can see how price retraced, used the daily fair value gap as an inversion fair value gap to trade higher to run the buy side liquidity, leading to an up close candle. Now, this move is very aggressive. In some cases, this might take days before running at the buy side liquidity. Like I said, this is a rare moment in price where price is moving around 50 to 100 pips in a day. This is a rare moment. But the idea is still aligned using the daily fair value gap as a support for price to trade higher to run the buy side liquidity. On the 1 hour time frame, from the opening price, you can see that how price traded below the opening price to the daily inversion fair value gap to use as a support to trade higher. Now, this is the manipulation phase trading below the opening price to a higher time frame point of interest. The higher time frame point of interest is the daily inversion fair value gap. Now, it can be a 1 hour point of interest, it can be a daily point of interest, as long as price trades below the opening price and supports from a point of interest. Trade below the opening price, support from the daily inversion fair value gap, trade above the opening price. During the London section, retracement to a 1 hour fair value gap, use this as a support area to trade higher to run a daily high before trading to the overall target of the buy side liquidity. Now you can see the phase, you can see the first phase trading to the daily fair value gap, and you can see the second phase above the opening price, using it as a support for a trend continuation to run the buy side liquidity. So the first rep you need to do before the London section is to understand what the price did during the Asian section. Now, in some cases, we might see consolidation during the Asian section where London section is going to be taking out the previous section low, which is the Asian section, before actually trading higher. But there's still other scenarios like this where the Asian section would deliver the first move in price, trading below the opening price to seek out a discount liquidity, trading above the opening price before the London section. So make sure you understand what the price did during the Asian section and how are you going to build up your trade plan with the idea of the power of three. Now, looking at this price, you can see the green area is the London section and the red area is currently the New York section. Currently priced at the New York section, I can say if you want to take advantage of any trade going in, is to look for a discount price to a 1 hour point of interest because from the swing low to swing high, price already went through the two most important phase, which is below the opening price and the first continuation. Now there might be a continuation from a 1 hour fair value gap, but for the immediate time, a retracement to that 1 hour fair value gap should be your draw on liquidity, mostly because price already took out a higher time frame point of interest, which is the buy side liquidity. We're talking about the London section in this lecture. To understand it more better, I just hope you guys learn how to align the multi time frame, understand how to align each time frame to have that clear perspective on where you are anticipating price to trade to, and take advantage when the lower time frame is ready to expand. So when the higher time frame is aligned with the lower time frame and the lower time frame is ready to expand, those are the times you take advantage of your setups. On the 5 minute time frame, first let's talk about how price respected the inversion fair value gap during the Asian section. After price retraced to the Asian section, you can see the 5 minute shift in structure running out this swing high. After running out the swing high, retracement, 5 minute fair value gap. This should be your entry, anticipating higher prices. And your first target it should be the previous day high. After price took out the previous day high, leading to the London section. Now on the London section, you can see the trade clearly. You can see how price retraced to the 1 hour fair value gap, shift in structure running out the swing high, retracement to a fair value gap and a 5 minutes auto block, trading higher to the draw on liquidity. Now you can see there's still a continuation in price trading higher to the overall target, which you can take advantage of with the 1 minute retracement to a 5 minute point of interest, which is the fair value gap before the run on the buy side liquidity. But you can see how it is easy for you to take advantage of the lower time frame when the higher time frame is fully aligned. When the lower time frame is aligned with the higher time frame, look at what price did during the Asian section to tell you what to expect in price or what to anticipate in price during the London section. That should tell you that this is a high probability London section for you to anticipate higher prices or lower prices, or this is a hands off section because due to my experience in price, I've seen many examples where it's not every London section that you trade. It's not every day you try to day trade. You look for those specific days where there's a high probability chance of you having a trade set up on the London section. Mostly when the higher time frame is ready to expand. When the higher time frame is ready to expand, those are the key moments where price will be expecting a higher time frame point of interest, which is the 1 hour. And when price will trace to that higher time frame point of interest, you will be taking advantage of the setup during those section. So the trade setup was the 5 minute fair value gap for your entry, stop loss at the swing low, and your first target is the previous day high. Now you can go for the overall target if you know how to manage your trade correctly, learn how to take partials and let the rest run. But I wouldn't advise you to hold a trade through the overall target to the buy side liquidity, mostly if you're a new trader. The point is that you want to go for the low hanging fruits to grow a good confidence and learning how to stick to your plan because being patient enough to wait for price to align itself to get to this point is well enough for you to hold your trade to the low hanging fruit, which I've told you guys that to see a market like this, to see a scenario like this might take time because this is a highly low resistance run on Hero USD. Now, it started from the dollar index, which we all know that they are inverse correlated. So there was a low resistance downtrend on the dollar index that led to the higher prices on Hero USD, running out the overall target, which is the buy side liquidity. But with a low resistance market or a high resistance market, as long as you stick to your plan, go for the low hanging fruit, which is the previous day's high, daily highs. This is the daily high, and know your overall target, know your trading range. Here is the trading range from the swing low to the swing high. Now, the more you get used to price, you grow plans, you develop plans that will help you to manage trade where you can take advantage of the overall trend, trading to your overall draw on liquidity. But as a beginner trader, I will advise that you go for the low hanging fruit, lock in a profit first before looking for high runs like this. So make sure you practice on this. This is on the Tuesday, the 20th of January 2026. Make sure you go through this price data and look at your own personal currency in which you do trade, which I will advise that you use the same currency that I'm using in this 2026 lecture so you can understand how to anticipate price, how to take advantage of price when it's fully aligned with your bias on a lower time frame perspective, because that was the whole purpose of having this lecture. So that is it for this lecture. See you guys in the next lecture.